Hello, everyone. Welcome to Is It Worth Your Home? A primer on HELOCs and home equity loans. Over the next 30 minutes, we'll discuss what HELOCs and home equity loans are, common ways they're used, and perhaps most importantly, how you as financial professionals can guide your clients through discussing whether or not they should obtain a HELOC or a home equity loan, or in some cases, helping them figure out which one they already have. As a reminder, this presentation is for informational purposes only. As for me, I am Maddie Orange, a financial coach and AFC candidate over at Orange Jalapenos Finance. Finally, a couple of housekeeping notes before we get into it. As you have questions, feel free to drop them in the chat. I do have the meeting chat pulled up. I'll be monitoring for any questions as they come in, and I will also rely on Andy to just verbally alert me if I miss any that are particularly time sensitive. And with that, let's get started. Let's start off with what home equity is, for the sake of not assuming knowledge. Home equity loan or home equity is simply the current market value, current market value of your home minus any liens or loans on the home. For example, if the current market value of your home is $500,000 and you have $300,000 left on your mortgage, your home equity is $200,000. Additionally, the two home equity loan options we'll be discussing today are home equity loans. This is a cash lump sum that the bank deposits in your bank account, and you pay that money back in equal installments over time, similar to like a 15 or 30-year mortgage. And the other one, which is perhaps more trendy, is the HELOC, which stands for Home Equity Line of Credit. So when you see the LOC, just remember line of credit. And with those basics out of the way, it is story time. I would love to hear from you all about a time either you, a client, or someone you know took out either a home equity loan or a line of credit. And if you could just quickly drop those in the chat. What I'm really looking for is why the home equity loan or HELOC was taken out. And so while I wait for a couple of those stories to come in on the chat, I'll tell you about two from my own life. One is a couple that I know who took out a home equity loan to pay for an extension on their house. Another one is I know someone who actually took out a HELOC to help pay for private school tuition for their two children. And thank you all so much for the examples. I see home improvements, a HELOC taken out just in case, home remodels, paying off credit cards, roof, gutters. This is excellent, y'all. Swimming pool, yes. So this next slide here is why tap into your home equity? Well, you all pretty much answered this question. There are a few common reasons why. The most common one is for home renovations or repairs, extensive ones, right? That will be several thousands of dollars. Paying down other debt. I'm so glad I already saw this in the chat. More common than people think, but taking out that home, especially the HELOC, to pay off high credit card debt, high interest debt. Another one is an emergency fund. Also saw this in the chat, taking it out just in case. Very common for HELOCs, right? Because you only have, it's like a credit card. You only withdraw if you need it. Down payment on either a future primary home or a rental property, investment property. Again, one of the known ways that a HELOC can be used. And believe it or not, for tuition as well, right? As I mentioned, it could either be used for private school tuition, college, things like that. So another reason to tap into your home equity well, not another reason, but kind of expanding on one of the reasons we already talked about, is home equity loans have a significantly lower interest rate compared to other loan options available to consumers. For example, credit cards can be 20 to 25% interest. I know it can be more, it can be less, but generally speaking, in this range. As opposed to these home equity options we're talking about, they could be as low as 7% if you have really good credit. So if this is the only way you're judging what type of loan vehicle to take out, the answer seems pretty obvious, right? You're going to want to go with 7% over 25 to 30%. However, there is an inherent risk in taking out any loan that is associated with your home equity. Can anyone tell me a risk of taking out a HELOC or a home equity loan over, say, using a credit card? And again, feel free to drop that in the chat. Defaulting on the loan, you could lose your home if it happens, losing your home. Yes, ding, ding, 100% to everyone, A+. Credit cards are unsecured loans, meaning if you can't pay back that credit card debt, certainly your credit score will tank. Lots of bad things will happen to you, but they don't have physical collateral to collect from you to pay back that loan. Home equity is a secured loan, meaning that if you can't pay back that loan, they could take away your house. They could foreclose on your house. Home value decreases, Jen. I see that, and we will actually get to that later on in the presentation. Thank you. So home equity loans and HELOCs are also known as second mortgages. These need to be treated as seriously as the primary mortgage on the home. In fact, I feel so passionately about this particular stance that I have composed a haiku so that all of you can remember how serious this is. As a bit of background, my husband is a spoken word poet. He won a national, or he was nominated for a national award for a haiku. So this is my time to shine. Low interest loans? Sure. Also, second mortgages. Don't pay, foreclosure. As an aside, you all are welcome to compose your own haikus or rhyming couplets or any short form poetry for the rest of this presentation. And at the end, thank you, Amy, at the end, there will be time to share them if you so choose. All right, moving on. Let's talk about the nitty gritty. We got 20 minutes left. Let's talk about home equity loans first. What do you need to have in order to qualify for a home equity loan? Quick reminder, home equity loans are kind of like 15 or 30-year mortgages in terms of how they are structured. First of all, you need to be a homeowner and ideally have at least 20% home equity. Some banks will grant you a loan with 15% equity, but not quite as common. You need to have at least a 680 credit score, stable, verifiable income, and a debt-to-income ratio of 43% or less. Debt-to-income ratio is also called DTI, and that is simply
Don't
your
worry, I'm
monthly debt
getting
payments.
some credits towards my
I'm just going to pause here for a second. I believe
AFCP.
someone is unmuted. If you could mute. DTI is your monthly debt payments, thank you, divided by your monthly income. That is how DTI is calculated. What makes a home equity loan as opposed to a HELOC? It is a lump sum payment that the bank deposits in your bank account, and that's how the loan starts. You have a fixed interest rate and fixed monthly payments, same payment every month until the loan is repaid. It's approximately a 15-year payment term. That's an average. And there are closing costs associated with the loan, just like a mortgage. You do have to put generally between 2 to 5% down in closing costs. Finally, a potential perk is that there is a possible tax deduction that you can take on the interest That is if the money is used to substantially renovate your home, increase its value, or to build additional
Yeah,
property.
should be fine.
Do note that this particular tax deduction, I believe, is only active through the end of 2025. So, especially if you're watching this recording in the future, tax code may have changed. Also, as a reminder, I'm not a tax professional, so do consult with one if you choose to take this deduction in the future. Home equity loans are better for projects or goals with a known cost, that you know pretty much how much money you need. This is important so that you don't take out more money than you need to. They're also good for borrowers who prefer a fixed payment. Again, like that traditional mortgage, you know how much you need to pay every month. Okay, quick knowledge check. I would like you in the chat to drop your answer to the following question. Choose the preferred scenario for a home equity loan. So not saying you couldn't do all three of these, but choose the one that you think is the best one. A, renovating the kitchen and deck. You have a signed quote, meaning you know, again, how much it's going to cost. B, a down payment in about 3 years on a future home. Or C, paying for college in 2 years. A, B, C. A, yes, I am so happy. Everyone so far, A, correct. A is the best answer. Why? Amy got it. One of the reasons why is you are adding, potentially, hopefully, adding value to your home. You could take that tax deduction. Perhaps more importantly, you have a signed quote. You know about how much money you need to draw down from the bank so that you don't need to take out more of a loan than is necessary. Now let's talk about HELOCs. As a reminder, HELOC stands for Home Equity Line of Credit. Unfortunately, line of credit makes people think of credit cards, but we know that they're not like credit cards, right? Because your house is on the line. These qualifications are the same as a home equity loan. 20% or more home equity, a decent credit score, stable verifiable income, and a DTI of 43% or less. However, how are HELOCs different from home equity loans? Well, instead of a lump sum, it is a line of credit, meaning the money is there for you to access if you need to, but you don't get all of it at once, meaning you don't have to pay it all back all at once. Instead of fixed interest and monthly payments, you have a variable interest and monthly payments, right? Like a credit card, it has the interest rate can change from month to month. Instead of a 15-year payment term, it's more like a 15 to 30-year payment term. And that is because HELOCs have two phases or two periods, which we'll get into in the next two slides. But the similarity that a HELOC has with a home equity loan is that it also has closing costs, and you can also potentially use that tax deduction. Now, let's talk about part one of a HELOC, the drawdown period. This is, again, about the first 5 to 10 years of the loan. You can vary how much you draw down from the HELOC from month to month, day to day. It's, again, like a credit card. For these first 5 to 10 years, or whatever the drawdown period is, you have interest-only payments. That means you only need to pay the interest on the principal that you've drawn down. Like a credit card, and Herbie, this might have been what you were alluding to just now, is the principal can be retapped, meaning if you draw down $1,000 next month, but you pay it back by the following month, you can draw down that same $1,000 again. And finally, as mentioned before, there is a variable interest rate during this time. So even if you withdraw the same amount of money each month and you pay it back immediately, your payments could still vary if you don't pay back the principal. Part two, the repayment period. This is the last 10 to 20 years of the loan, depending on the length of the loan. In this time, you cannot withdraw. There are no withdrawals allowed. The line of credit is closed. At this time, very, very important, you are paying back both the interest and the principal. In that sense, it is much more like a home equity loan or a primary mortgage. And generally, this will also still have a variable interest rate, unless you have converted it to a fixed rate. This is occasionally an option, definitely something to tell your clients to look into as they are establishing a HELOC. If they convert it to a fixed interest rate, again, it essentially then behaves like a home equity loan. HELOCs are better for unknown costs. Say they do want to renovate the home, but they're planning on drawing it out for a little bit. They don't know exactly what they want to do. Might be better for a HELOC. And they're also better for borrowers who can afford that payment increase from drawdown to repayment period. And also ones you can plan for varying payment amounts that have perhaps a more flexible budget. Quick knowledge check. Choose the preferred scenario for a HELOC. And again, just drop your answer in the chat when you're ready. A, supplementing ongoing tuition. You don't have quite enough in the 529 or in the savings account for tuition. Home renovations that you plan to do over the next 5 years instead of all at once. Or C, consolidating credit card debt. All right, I see them all coming in. Great job, everyone. A+ again. It is B, home renovations over the next 5 years. You might not know exactly what the cost is. You'd prefer to draw down as needed, and you can take advantage of that tax deduction. Now let's move on to cautionary tales. These are things to keep in mind as you are counseling clients or considering one for yourself. The first is consolidating unsecured debt. Does the client want to take out a HELOC or a home equity loan to pay off their credit card debt? I'm not saying they can't, but that is something to consider. Is the client ready for that increase in payment amounts from just interest to principal and interest? Is the client ready for their home value potentially decreasing? Because as I think someone mentioned earlier, the amount that is granted to you in a home equity loan or a HELOC is based on the current market value of your home. So if the current market value is 500,000, they give you a home equity loan of 200,000, you now have $500,000 in debt, right? Suddenly your home is now only worth, 5 years later, only worth $450,000. If you haven't paid back that home equity loan, you are now underwater on the house. Is the borrower ready for that scenario? And especially if this loan has been used to consolidate and pay off previous debt, is the borrower at risk of continuing to incur debt? If so, they are now essentially doubly in debt. Not great. With all those things in mind, here are some potential alternatives to HELOCs and home equity loans. I'm not saying these are necessarily better or worse, but again, depending on the scenario, could be viable options. The first is, good old postpone the expense and save up cash. Do you even need to take out a loan or incur debt to begin with? Are there vendor provided options? For example, a year and a half ago, my husband and I redid the windows and siding on our home. We had the cash, but we asked the vendor if they had any potential financing options, and they actually had a 0% loan available to us because 3-year 0% loan because of our credit scores. And so we opted to take that instead, and we kept the money in a high yield savings account. And that was a decision we made, and so far it's worked out for us. If it is a smaller uh, expense, does the client or borrower want to consider taking out a new credit card with a 0% interest rate? Really, this only works if they can pay back the expense within that intro rate period, which is generally 12 to 18 months. Feel free to correct me if I'm wrong. So a little bit tricky, but could work with a responsible borrower. 401k or 403b loan. Again, not saying it's better or worse. However, it is generally faster to take out a 401k or 403b loan. I know this is it's going against our traditional counseling of never tap into your retirement account. But again, personal example, we were looking at buying the home I'm in now, and we wanted to buy this home before selling our previous home. So we took out those 403b loans, which is the like nonprofit or educational equivalent of a 401k. We used that loan to put the down payment on this home, and as soon as we sold our previous home, we repaid ourselves. So that was a decision that we made. And finally, the cash out refinance. I think you all are probably familiar with cash out refinance, but you replace your primary mortgage with a new one. Really, this works best if the interest rate is lower than your current mortgage. And then in addition to taking on the previous balance of your mortgage, you also are given that lump sum payment that you then now have to pay back along with the mortgage balance. So it's sort of like squishing together the home equity loan and your previous mortgage together into just one loan vehicle. If you have any questions about these, do save them or drop them in the chat, and we'll scroll back at the end. Moving on, looks like 6 minutes left for client questions, meaning the next few slides are some suggested prompting questions that you can share with your clients as you're counseling them on whether or not they should get a home equity loan or HELOC, which one they should get. And in the case that they come to you and they already have one, but they're not really sure what it is, how you can help them figure out what type of loan they have. The first one, or the first topic I guess, is what type of project is it, right? Let's think about the expense. Is it one large payment, or several payments that they're going to make in a very short period, or is it multiple purchases over time? Thinking about big renovation right now versus smaller renovations over the next few years. What is the timeline? I guess I just said this. Is it happening now? Is it happening in the future, but they know it's going to happen? Do they know the cost? They are taking out a loan. How are we making sure that they're not taking out more money than they need to take out? And I cannot say this enough times, are they converting a debt type? Are they trying to pay off their, yes, high interest credit card debt, but unsecured credit card debt? Thinking about your clients' behaviors and their preferences, do they have a tendency to overspend or incur debt? Is taking out this HELOC ultimately just going to put them in further debt instead of erasing it? Do they understand what a secured loan is versus an unsecured loan? Are they comfortable with varying loan payments if they're taking out a HELOC, or do they need that stability of equal loan payments every month? And do they have the ability to repay the loan if their income is reduced? So in addition to the home value decreasing, we do need to think about what if the client has a significant reduction or elimination of household income? Are they, able to navigate that? Finally, some clarifying questions about loan terms. Ideally, these conversations happen before they get the loan term, but as one client asked, which one did I get? So these will help, hopefully. First, is it a variable interest or a fixed interest loan? Is it a lump sum or a line of credit? If they don't know what line of credit means, you can just explain. It's like a credit card. Do you draw down from it and then repay it, or did they give you all the money up front? What are the drawdown and repayment period terms? How long are they? What is the interest rate? Or, is drawdown a variable interest rate and repayment fixed interest? Can you in any way negotiate for a fixed interest term once repayment period starts? What are the setup and closing cost fees? Again, that can be 2 to 5% of a loan. If you're taking out a $200,000 loan, that could be like $10,000. And that's the end of the presentation. If anyone would like to share a rhyming couplet or other haiku or other short form poetry, you're welcome to at this time. Also, any questions? Happy to start addressing them now.
You have
Andy,
a three in there already. And no,
yeah,
none before. So just the last that have come in.
thank you. Um, would you ever recommend a HELOC or HELOan or merely just provide guidance and knowledge when it gets brought up? Great question. At least my practice tends to be, I'm very much client led. I do tend to work with people that are higher income, not on that, not in crisis. So I would really lean on more guidance and knowledge. That said, if I strongly believed that someone was going to incur more debt or put themselves in more financial jeopardy, I would recommend against it. Yes, Amy points out taking out a 401k loan is not recommended, especially if you lose your job. That is a great point. You will have to pay off your 401k loan almost as soon as you lose your job. That is a very good point, Amy. We did take it out because we thought that was definitely a gamble, and we assumed that we would sell our house immediately, and we were under contract within less than 48 hours of listing it. So that was lucky. Does the lender require information about how the money will be used? Yes, great question, Tamara. So this is one of the reasons why we didn't try that sneaky hack of taking out a HELOC to put down a down payment, is because lenders will ask, how do you plan on using the money? Using it as a down payment on a future home is not an acceptable answer, right? They generally want you to improve the home that you have. Jen asked, can you refinance a HELOan to lower the interest rate? Andy, I'm not sure if you know the answer to this question. I do not know.
I think it would depend on the financial institution and yeah, so
Great.
imagine it's very similar to any other kind of loan. You'd be charged the fees again, most likely.
Yes, very important point is, and I will stop sharing.
And I am going to hit stop.